Hi there, I'm Dr. Victoria Cloud, and I'm here to explain some accounting. This video focuses on revenue recognition, and there's three illustrations in this video. The first one is looking at service revenue over a 12-month period. The second example is looking at the sale of some inventory in a store with a return policy. And the last one is the sale of some inventory online where the inventory is not manufactured until after the inventory has been purchased by the customer. So I'll put the template and solution links into the description of this video.
Part 1. Sussex Limited receives a non-refundable upfront fee of $90,000 from Harrington Limited on the 1st of March 2015. Under the agreement with Harrington Limited, Sussex Limited must provide an ongoing advice services until the 1st of March 2016. We're asked to prepare the journal entry, if any, to recognise revenue for the above transaction. So what we need to think about is, what is the earnings process? What is the amount of activities that need to be done, and when have these activities been completed? So we're looking for really the majority of the work to be completed in order to earn this revenue. So upfront, that's too early, because this is a contract to provide ongoing services for a 12-month period. So initially, when we receive the $90,000, this is unearned because the substantive amount of work has to take place over the coming 12-month period. So at the 1st of March 2015, the journal entry we're going to record will be debit cash $90,000 and credit unearned advice fee $90,000. So we're going to earn over the coming 12-month period a straight line of the revenue. So we could divide this up into monthly journal entries. What we've done is just summarize the journal entry for the entire 12-month period. So the sum of all of the journal entries as we've earned the revenue would be debit unearned advice fees $90,000 and credit advice fees revenue $90,000. So we're looking for that substantive amount of work to be undertaken in order to earn the revenue. So in part 2 of this question, O'Neill Limited skiing shop sells some gear to a customer. The sales price is $1,000 for cash on the 1st of June 2012. The customer has the ability to return the goods during a 7-day return period. Typically, O'Neill Limited estimates that 1% of customers will return skiing gear as they have a strict returns policy. Returns can only be made if the size is incorrect or the product is faulty. They only allow an exchange of goods. So we're told what the sales revenue is for the period and the cost of goods sold. We're asked to prepare the journal entry, if any, to recognise revenue for this sale and include the appropriate date. So we need to think about that date. So can we estimate with reliability how much customers will return of goods? And the answer to that is yes. We can estimate that only 1% of customers return their skiing gear. So we don't have to wait for the 7-day return period to elapse. We can record the recognition of revenue at the point of purchase. So the date for this journal entry is going to be 1 June 2012. So we debit cash $1,000, credit sales revenue $1,000. We've recorded the revenue for this transaction. Part 3. So a customer in Sydney places an order for a laptop computer with Dell on the 10th of January 2013. So they pay $599. They do this through a direct bank transfer. So then the laptop is assembled, and that assembly is completed on the 15th of January 2013. The laptop is shipped on the 16th of January 2013 from its assembly facilities in Penang, Malaysia. The customer receives this laptop on the 22nd of January 2013. Dell always uses a third-party shipping company, FedEx, to deliver products to their customers. So we're asked to prepare the journal entry to recognize the revenue for the sale of this laptop. So at the very beginning, on the 10th of January, can this company earn the revenue? Can Dell earn the revenue from the sale of the laptop? The answer to that is no, because they haven't actually assembled the laptop. It's not yet built. They haven't undertaken what they need to do, the substantive amount of work, to earn the revenue. Also, they need to do an additional step in order to earn the revenue. This is that they need to ship that laptop to the customer. So they need to engage in that shipping process. So we can recognize the receipt of the cash up front, but it's not revenue at that point. We haven't earned the revenue. So on the 10th of January 2013, we debit cash $599 and credit unearned revenue $599. We then can decide on, and we can make an assumption about whether we believe that all of the risks and rewards have been transferred to the customer. And the point at which it could be transferred, you can make an assumption that it's based on shipping. This is because there is a third party involved, FedEx. So FedEx would then take on that risks and rewards. So if the customer does not receive their laptop, it's FedEx who would have to replace it. So they would have insurance for that. So if you have made that assumption that FedEx is taking those risks and rewards, they're ensuring that delivery, then the date you can recognize the receipt of revenue is the 16th of January 2013. So you would debit unearned revenue $599 and credit sales revenue $599 to record the recognition that you've earned that revenue. Alternatively, you could make an assumption that Dell is ultimately still bearing the risks and rewards until the product is actually delivered to customers. If you made that assumption, then the date for that journal entry would be the 22nd of January. So then we come to the last part of this question. You're asked to write a brief justification for the date that you recorded the revenue being earned by Dell. So if you had assumed that the risks and rewards are not transferred until delivery, and you would have written an answer that says that Dell bears the risks and rewards, not FedEx, then you would record and you would justify this as because those risks and rewards are not transferred until delivery, you would record the 22nd of January, the delivery date. But if you believed that the risks and rewards are transferred to FedEx, then you would record that earlier delivery date of the 16th of January, and you would record your answer to be that the risks and rewards have been effectively transferred because a third-party shipping company is being used.
Thanks for watching this video, and check out my other videos on this YouTube channel looking at other accounting topics. One that might interest you about revenue is the percentage of completion versus on completion method, which looks at different ways of recognizing revenue over a multiple year project. Thanks for watching.